Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in there and see what people are sharing on social media. If you want to follow me, it's at Finding_Finance. And if you want to join our community, finding-value.com is where I dive deeper into these topics, looking for potential investment opportunities in the commodity space because that's where the value is at the moment. And I search using technical analysis and fundamental analysis to find potential investments. So coming down to the Kobayashi letter, another sign of a U.S. recession. The U.S. manufacturing sector has experienced its second longest downturn in modern history. The ISM Manufacturing PMI index has shrunk in 19 of the last 20 months, making 21 months without two consecutive readings of an expansion. The industry has only ever seen a longer period of contraction once, during the late 1990s, when it contracted for 26 months. Meanwhile, the ISM Services PMI index fell by 5 points to 48.8 in June, putting both industries in a downturn at the same time. If these indices do not rebound soon, the U.S. economy may indeed be headed into a recession. There are signs of weakness in this economy. So there's the weakness and the duration of that weakness. The only time that it's beaten it was back in the 90s over here, where we had a longer amount of manufacturing slowdown consecutively. Scrolling back, here we go. Grady here, and I like sharing these charts. He's got some pretty solid long-term charts here. He says, if you want to make a huge amount of money in the next few years, this is a very important chart to focus on. I get many questions now about the reasoning for being so bullish on the precious metals sector moving forward, when they appear to underperform the metal over the long term. Well, the sector is not meant to be held long term previously because the charts were not ready for it. They are now. It is as simple as that. One has to differentiate between the price history of the past and what one expects going forward. Saying that precious metals miners is not a good buy now because they historically have not outperformed the metal long term has no relevance. The charts tell us now that the coming years look extremely bright for the precious metals. That is the only thing that counts. Nothing else matters. Remember that you are not buying the mass media news, opinions and interviews, wrongly interpreted charts, the why to intraday moves, or all the selling themselves narratives. You are always only buying price, so focus on that and not anyone's opinion. Also, one cannot play resume bull with a bearish mindset. That's why most missed the 2022 lows and why many called for an early top on the way back up. Most simply have to be on the wrong side for big moves to start. Market sentiment has to be at extremes at major tops, bullish, and bottoms bearish for a turn to happen. And that means most have to be wrong at big turns. Think about that and what it really means. So that's what he's got there. And this is GDX versus gold. You can see that we are starting to put some pretty good candlesticks in the right here, and that's generally what I look for. These big bullish candlesticks that start to show up, I call it the green army. We've got a nice big bottoming bullish candlestick here called at the shakeout that he's got. GLD, the ETF on gold, is already broken out. And we've got GDX, the large gold miners, which are also breaking out here recently. So I don't understand why people aren't bullish in the mining companies and or in gold and silver. Another thing, if you look at, is gold and silver generally do very well when the yield curve uninverts. If we get a lowering of interest rates, which is, I think, a good probability, and if the market does slow down, that's where gold gets its safe haven status. This is like right in the alley of when gold outperforms. And we've got the breakouts to prove it in technical analysis here. So I don't know. I'm pretty bullish on the miners, even alongside with the precious metals. So I know a lot of people aren't, but that's how you make money. You have to make money, or you make money by going against the sentiment and going against the crowd. What he has here is a 10 plus year long base equals the bigger the base, the higher in space. That's what he's got there. Gordon Johnson, history agrees with JP Morgan and Citi, so does GLJ research. And, it doesn't matter who agrees or disagrees. That's what I found in history. All that matters is if you're right or if you're wrong. But he's got a fractal overlay. He's got the consumer price index year over year percent today, and that's overlaid over the consumer price index of 66 to 82. We've got a similar fractal playing out, and what he might think is we've got another big surge in inflation coming, which would peak in 2028 or something like that. And that does feel like that could potentially occur like that. So I do agree with that, but you shouldn't gain any sort of comfort knowing that other people think what you think. This isn't a contest of having people have a consensus. It just doesn't matter. What matters is the fractal right, and why is it right? Why would we see another inflationary impulse move higher? My reasoning is that we are still in the middle of a real estate cycle, which pumps out inflation, credit creation, and historically, credit creation from the real estate cycle has been a driver. We also have fiscal spending that is pretty high, which is another inflation driver. So inflation it's being driven by fiscal spending, but it could also be driven by monetary spending if they were to lower interest rates. So Powell's in a difficult position because I think if he lowers rates, he goes right into the affordability of a bunch of people who want to buy homes, which would be inflationary because of credit expansion from the monetary side. If he keeps interest rates high, then he's got the fiscal side to deal with, and deficits and interest payments and interest rates. So either way, I think it's going to be an inflationary backdrop. And this may not move exactly the same. If you go back and you look at the 66 to 1982, our real estate cycle went up and the real estate came back down. We overbuilt, and then we overbuilt. So the real estate cycle is really what caused these three big waves. And these waves here, they usually rhyme and they're very similar, the fractals, but there could be different reasonings that caused those moves. Like COVID here was the move that really pushed it lower there. It wasn't necessarily a real estate crash. Game of trades here, and I was just looking at this data and I was trying to figure out what information I can glean from this. So what this is, it's credit card defaults are sharply rising. This is the case for all age brackets, especially the younger ones. The 18 to 29 age bracket is at its highest level in plus than 10 years. This is worsened by over 1 trillion in total credit card debt. So I was looking at credit card defaults rising. I was just kind of looking at the trend, and I was looking at the 18 to 29 because it looks like it's the easiest one to see a big trend on. And I don't really see a trend of anything. It's not like this was rising and we just get these recessions at the end of it necessarily. I mean, it looks like it did here, maybe here, but that's not really, that was a COVID event. That doesn't really sit well with me. And this one, it peaked after the recession. So I don't know how much credit card defaults rising actually matters to anything. I don't know if it's linked to a slowdown because it doesn't look like it is. I mean, this was rising before and after that slowdown. And this one was before, but this was really a real estate market that was getting hit. I guess tertiary effects is that credit card defaults going up could be a signal of stress within the family. And maybe if you're towards the end of a real estate cycle, it's an indication that they can't pay their mortgage. Or maybe it's an indication that they can't pay their credit card, but they're still going to pay their mortgage. Tough to say. So I'm just trying to figure out, like, what would this actually, what would this data tell me? I don't know if it tells you that much because if it's falling, a lot of these, that's when you get a slowdown is when all this contracts, when it's falling, not when it's going up. Yeah, that was funny. Coming back down, we've got if the Fed loses control of the VIX, which is the volatility, you will see commodity inflation unseen since Weimar Republic days. So I was kind of reading through this. So what he says, what you are seeing in the stock is the Fed redirecting inflation into stocks from commodities. I actually partially agree with that. I think the Fed needs to keep money in intangible items like Bitcoin, technology stocks. It prevents money rotating into commodities. And if money rotates into commodities, that is where you see the inflation. So the money exists in the system, and where it exists is in financial assets. They, the Federal Reserve, in order for them to keep inflation low, the money's in the system already for that to occur. They need to keep it pinned over in technology stocks and crypto and all of those sectors. If they can't keep it pinned over there, that money's going to rotate out of those sectors and go and chase performance somewhere else. If it happens to be chasing performance in commodities, you'll see it in the consumer price index. And that's what they don't want. They don't want the money to flood into the consumer price index. So they're probably doing everything they can to prevent that from happening. But what's going to, I think, occur is that they're going to try to do that for as long as they can. The economy is going to slow down because of increased interest rates. And then the money is going to rotate over when the dollar drops. Things will start to deteriorate and money will rotate over once everyone is sucked into that technology sector. The bubble will pop. When the bubble pops, people will sell and they'll look for something else, and the cycle will continue somewhere else, in my opinion. Invest in assets. This is 5 secular trends to look for the next multi-baggers. Obesity, digitalization, aging population, health, obsession, and artificial intelligence. And he says, what other secular trends are worth researching? I wouldn't even look at any of these. I'm not interested in a secular trend without value. So I'm looking for value on top of all this. I think commodities is the best secular trend over the next 5 years. And it deals with where we're at in the real estate cycle. It deals with the valuations of commodities, and it deals with the equities as well. If we get a large inflationary move, hard assets generally do well. I think we are in a bubble in technology stocks based off of valuations. I could be wrong, but I don't think they're well valued. There are other technology stocks around the world that are well valued, like some Chinese equities, some emerging market equities, and stuff like that. So I think the next big trend will be commodities, energy, and precious metals. Those will be the biggest, and they're not on this list. And while health obsession and artificial intelligence and all that, that's great to be looking at that. I think the trends in precious metals could be far larger than all those trends combined if we get the market conditions that I think are coming. Salvation said, should a 40-year-old prioritize buying a Bitcoin or a house? I was just reading this, and the first thing that came into my mind is that is absolutely a stupid question. Who the heck would prioritize Bitcoin over buying a house if you need to live somewhere? Now, obviously, things can be based off of valuation. You can rent and you can put some of that money in investments or whatever. I'm not fully convinced on Bitcoin, guys. Obviously, I think anyone who's been part of the channel knows that about me. I will change if Bitcoin can find some uses, but right now, I don't know. I just can't jump on the bandwagon. But I've never jumped on the technology bandwagon. I've never been a tech guy. So I've always been, the manufacturing type of hard assets and building wealth and cars and stuff like that. Bitcoin and the electronic stuff and digitalization stuff, I've just never been big on it. So I use things, yes, but I don't get as impressed with the technology stuff. Just never have. Manish Pabri once said, I'm a shameless copycat. Everything in my life is cloned. Here's the stocks the best investors in the world own. So let's just check out what they own for the heck of it. So here's Warren Buffett. His biggest shares that he owns is Apple. I think that's Bank, BAC. We've got AXP, which is American Express. KO is Coke. CVX is Chevron. Oxy Petroleum. I think that's Marathon. That's Heinz Ketchup, I think. Kraft Heinz. CB, I'm not sure about that one. That, I don't know what that is. C is Citigroup. So he's got a couple of banks. I think that's Bank of America, I think. But yeah, that's what he owns. Terry Smith, I'm not really too familiar with Terry Smith, but he owns Microsoft, Meta, SYK, Visa. ADP is a payroll processor. Um, Google, Pepsi, looking Procter Gamble, Cord Energy, I think that is. Otis is an elevator. I used to work, the company I worked for used to own Otis. Joel Greenblatt, he owns Other. Google, Snow, Microsoft, a lot of technology companies up here, the SPY, a bunch of other stuff there. Howard Marks, he owns CHK, I think that's Chesapeake. GTX, Starbulk Shipping, Vale, STKL, and a bunch of other small stakes in a bunch of other companies like Freeport, Petrobras. This guy's got a portfolio more like I would have. Howard Marks is more similar to me, just by looking at a lot of these companies. Manish, he's pretty concentrated. He's got one, two, three, four companies. AMR, CEIX, HCC, and ARC, which are all coal companies. He is 100% in coal. Go Manish. Here's Chuck. So Chuck's in MasterCard, KKR, O'Reilly's. O'Reilly's Auto Parts had to do that. Visa, DHR, which is a, no, is that DR? No, that's DR Horton, not that. That's Donahue, whatever, I think. There's that one. Guy Spear, however you pronounce his name. Berkshire B, American Express, Bank of America, MasterCard, Race, BRKA. This guy basically should just put all his money in Buffett, I guess. Bill Ackman, Chipotle, Hilton. I don't know what QSR is. Google, HHH, and Google. Lilu, Bank of America, Google, Berkshire Hathaway shares Apple and EWBC. Francois, whatever. He's got a variety of holdings. I'm not going to go through all those. A lot of tech, a lot of some banks and financial stuff too. And here is Lawrence and his opinion of Coinbase. And this is what, when I look at this stuff, I think Tether, there's some really weird stuff with Tether. I look at that and I'm like, man, that's fraudulent. And Tether is basically what holds all of the valuation of a lot of these cryptos up. So this is Coinbase. This is the on ramp and off ramp out of crypto. He says Coinbase is a criminal enterprise shitbag company. I have a very small stub amount of Bitcoin in Coinbase that I've been trying to transfer out unsuccessfully for 60 plus days. Each time I try to transfer, I get a message that I'm out of an abundance of caution. My account is locked for 30 days. I submit support tickets and get no response. Next step is a letter to the California Attorney General. These people are so bad. I also had a similar experience about a year ago when I moved the bulk of the coins I held there. Just an awful company. That really makes me want to jump into crypto. And I know Coinbase is just one, but still, I when you start to look around all of these things, you just see trash everywhere. The on-ramp and on-ramp, off-ramps, go look at Tether. You start looking and researching this stuff. Uh, it all seems like a scam, guys. That's what it seems like to me. HFI Research says last week, Wednesday, we published our thoughts on the natural gas market to subscribers. Following the recent jump in natural gas, the market should not assume quickly that recovering production will stall. So this is what he has trading. We think with where natural gas is trading today, this is close to a bottom. We'll be looking at possibly going long in oil, which is a bad idea. We're going short on coal, another bad idea. In the coming days of September prices getting closer to $2 MMBTU, we think the contango we see in the market is still too steep and there's more downside risk in the winter months. In terms of upside, the market will not want to push prices back to 2.5 anytime soon, as it knows full well that production recovery will resume if prices get back to that level. I see an upside to 2.25 MMBTU at the most, given the bearish backdrop. A lot of these futures holdings, ETNs, I think they are, they asymptotically approach zero. It means they go to zero very slowly, but never ever reach zero. That's the leverage and the rollover of a lot of these contracts. I would not play any of those because of that. And that goes for leveraged ETFs too. Leveraged ETFs generally trend towards zero. So if you're going to do anything, I would short them. I wouldn't go long. But the leveraged ETFs also would be a pretty rough ride because they're very volatile. And then Game of Trade Series says, caution, trucking employment has fallen off a cliff. This has been a recessionary signal since 1991, and I think we already went through the recession. it's already down. I question this because usually when it starts to go lower, that's when you need to worry. Then the recession comes after the fact. This one obviously went down quite a bit too in 2008, but the big move lower, it's already basically occurred. I don't know how much more downside we have in trucking employment falling, but it looks like to me that bulk of the move is already done. And the private sector looks like it's bottoming here. But that's just what I see. And that's all I've got, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.